Hello, this week we'll be looking at Chapter 9, which covers financial planning and analytics. To put it in a short form, this week is about budget. It's learning how budget is done, but your chapter is quite detailed in the sense that it covers the reasons for the budget and what happens after the budget tends of post-analytics. Now, generally, the purpose of budget is a planning scheme is to plan the activities for the organization and also to forecast some of the resources that will be needed, the operation of the business, and to have an idea about the expected performance given the level of operation. In a budget, we have different types of budget, but the fundamental part of it is, or the core part of it is the master budget. You have a budget for operation, and then you have budget for you have administrative budget, and then you have budget for financial statements. So in this one that you have in front of you here, types of budget, we have budgets such as budget for materials, budget for production, budget for sales, and so on. And within the production, you have a production schedule budget, and then you could also have a direct labor budget, overhead budget, and many others. As part of budget, there's also part which we call the financial statement budget. The financial statement budget, which some textbook may call the pro forma financial statements, consists of budget for the income statement. In other words, the profit and loss statement budget, the balance sheet budget, and then the budget for statement of cash flow. All of this combined is the financial statement budget. Here are some of the components of master budget. The master budget perhaps is a budget that covers eventually all small scale budget or delegated authority budget or departmental budget. So you have budgets such as the sales of service, and then you have the production budget, and then you have all of these series of budgets, which are a breakdown of the production budget, like direct material budget, direct labor budget, overhead budget. These three here are core part of the production budget. And for the sake of service, you have administrative and selling budget. And then with all this information here, you prepare your cash budget. Your cash budget will look at the cash in and cash out, which means the cash flow, the cash receipts, and then the cash payments. We account for all of that. The excess of the cash budget is also to identify any shortfall in your cash so that the company will know how much that they may need to borrow or to issue capital in order to raise funds for that shortfall. And then we have budgeted income statements, which of course is information that is collected from all of these other items like direct material, direct labor overhead, which is going to be the cost of goods, and then it's only an administrative expenses. And then you have the balance sheet budget, which sometimes is called the statement of financial position budget, taking into recognition the current assets, the fixed assets, the current liability, and long-term liability, as well as the owner's equity. And then you have the budgeted statement of cash flow. That some of the information from here could be linked to the statement of cash flow, such as the cash balance in your cash account or check balance, or cash and cash equivalent asset. Right here, we have the activity-based costing versus the activity-based budget. So activity-based budget basically will look at breaking down the activities that the organization is going to perform, such as the forecast for product and services to produce and customer to serve. Resources required, the processes that will be required, like, for example, we talk about batches, how many setup batches will be required. So all of this constitute part of the activity budget. This information here, which are the activities that are were analyzed and broken down, can be used to estimate the cost of the product. With this information here, we could implement activity-based costing because we know what needs to be done, how many units needs to be, how many units of resources will be needed, and combination of all of that information will be implemented under the activity-based costing approach. Now, in as much as I'm not going to go into so much details about the rest of the PowerPoint, but let's have a quick look and see how the budget will look like if you were to prepare budget, giving certain information. So let's say, for example, Brickers Incorporated is preparing budget for the quarter ending June 30th, and that the budgeted sales for the next 5 months are April 20,000 units, May 50,000 units, June 30,000 units, July 25,000 units, August 50,000 units, and then the selling price is $10 per unit. This information could be used to forecast sales, and also the information could be used to forecast cash flow. We don't have complete information with respect to cash flow, but we just need perhaps just one additional information, such as the percentage of sales to be collected in cash in the months of sales. With that, we can prepare the cash flow statements. Now, let's assume that given this sales budget, we want to calculate the expected sales revenue. Remember, there's difference between sales revenue and cash flow. So students tend to misunderstand these two. Sales revenue could be sales you make in cash or in credit. So now what this example is showing you is focus or estimating or making budget for your sales revenue for each month. Now we know that the budgeted number of units to sell in the month of April is 20,000 units, and the selling price is 10,000. So in the month of April, the forecasted sales revenue will be 200,000, which is going to be 20,000 multiplied by 10, which is the selling price. So 200,000, maybe 500,000, and so on. And then this is ideally the second quarter of the year. And if we add this value together, it will give us a total of $1 million as the sales revenue for the second quarter of the year. Now, we could also do it in a different way by just adding the number of units together multiplied by the selling price per unit. Now, the production budget. In the production budget, there's information here. The management of Brickers Incorporated want ending inventory to be equal to 20% of the following month's budgeted sales in units. On March 31st, 4,000 units were on hand, and let's prepare the production budget. Now, take note that the ending inventory has to be equals to 20% of the following month's budgeted sales in units. Now, if you want to put that in context, in the month of April, the ending inventory should be 20% of 50,000 units. Okay, so that will give you 10,000 units as the ending inventory will be expected at the end of April. So that 10,000 will be carried over to May as the beginning inventory. So here's an example. In May, the production that should take place, this is an estimation. This is not the actual yet. Actual could vary based on events. So the forecasted number of units to sell in April is 20,000 units. The ending inventory should be 10,000, which means at the end of April, they should have 10,000 units in stock. And then the total number of units required in the month of April is 30,000 units. It is possible that there was some sales in March and some units as ending inventory in March. So we'll have to take that value away from this total number of units required to determine how many more units need to be produced. So assuming that at the end of March, there was 4,000 units that was in the finished goods inventory, what is required to produce in the month of April in order to meet this 30,000 requirement for the month of April will be 30,000 minus 4,000. That will be 26,000 units. So this company will have to produce 20,000 units in the month of April to meet the required number of units to sell in April and to have any inventory of 10,000 in April. That goes on for the rest of the month as well. Now let's look at the direct material budget. So in the direct material budget, it basically focuses on the budget for direct material only. Let's assume that at Breakers, 5 pounds of materials are required per unit of products. Now the material wants the management wants materials on hand at the end of each month to equals to 10% of the following month production. On March 31st, 30,000 pounds of materials are on hand. Material cost is 40 cents per pound. Let's prepare the material budget and basically use this information here. Remember, the important information here is the ND balance of the raw materials account or direct materials account. And then on 31st March, this is the amount of direct materials that we have had, 30,000 pounds. And the cost per direct material is $40 per pound. With this information, the raw material budget will look similarly to this for each of the months. We could sum that up to quarter or even sum it up to yearly budget. Now, if you look at this monthly budget, you'll see that the production required in April, which we calculated in the previous calculation here, is 20,000 units. And then to produce one, you were told that it will require 5 pounds of material. Now, right here, 5 pounds multiplied by the number of units, that will give you 30,000 units of the direct material required to produce these 26,000 products. And we look at the desired ending inventory, which is, as we were told here, is 10% of the direct material required for the month that follows. So in the month that follows for May, if we apply the same principle, we apply calculated the number of units for to be produced in April to May. If the number of units here is going to be 46,000, so we basically multiply that 26,000 by 10%. 46,000 multiplied by 10%. That will give you 4,600 units that would be required to be produced in the month of May. But that is, I'm sorry, that is number of units, okay? So we won't use that number of units because that'll be different, because the number of units was 20. That would have already been included in this 46,000. So what we need to do is to multiply 46,000 by 5 pounds. Then we'll have 230,000 units of raw material required, multiplied by 10%. That should give you 23,000 units. That'll be ND raw material that will be required in April. So I'll explain that again. So in May, the number of units required to be produced is 46,000 units. And then to produce 1 unit of this 46,000, it requires 5 pounds of the direct material. Now, the total number of direct material required in May is 230,000 units. So we want to buy this raw material in the month before May, which means 10% of it has to be in the ND raw material inventory in April. So to do that, we multiply 230,000 multiplied by 10%. That is 23,000 pounds of raw material that must be in the ND, that must be in the raw material inventory at the end of April. Now, the total amount of raw materials required in the month of April will be 130,000 plus 23,000, which is going to be 153,000 pounds of the direct material. It is possible that at the end of March, there was some raw materials in the direct materials inventory account, which means we don't have to buy that amount of direct material. If that is the case, which in this case, in this example, is 30,000 units, we'll minus it from this amount of direct material required. That means the amount of direct materials that will be purchased in the month of April will be 140,000 units of direct materials. So which means 153,000 minus 30,000 units. So the company must purchase 140,000 units of direct material, of 140,000 pounds of direct material in the month of April to meet the requirement of direct materials to produce 26,000 units for April and have any balance of raw materials of 23,000 by the end of April. The same principle applies in May. So in May, the total amount of raw materials required in June will be 145,000 pounds, and 10% of this must be carry forward from the month of May. So which means 145,000 multiplied by 10%, that will give you 40,500. So the total direct material required at the end of May will be 244,500. And then if there's any beginning raw materials carry forward from May, you minus it from this amount, that will give you the direct material that must be purchased in the month of May. Similarly, we look at that in June. If we have information about the quantity that will be required in July, then we can add 10% of that, which in this case is given here as 11,500. Take 10% of that July raw material required and add it to this to know the total raw material that will be required in June, and then minus any beginning raw materials of 40,500 to determine the raw materials that must be purchased in June. Now, in terms of the direct materials, you could see further illustration here of this information you have here. So basically, we say July production in units is 23,000 units, and then the direct material to produce 1 unit is 5 pounds. 5 pounds multiplied by 23,000 will give you 150,000 pounds of raw materials required. 10% of that, we take 10% of the inventory, and the June desired ending inventory is 11,500 in the month of June. Now let's look at the case of direct labor budget. In the direct labor budget, the same principle we apply in the direct material could also be applied to direct labor. We look at how much time will be required to produce a unit. In this case is 0.1 hour. And if that is what is required, we look at how many units need to be produced. So the company has a no layoff policy. So all employees will be paid for 40 hours of work each week. And in exchange for the no layoff policy, workers agrees to a wage rate of $8 per hour, regardless of the hours worked, no overtime pay. For the next 3 months, the direct labor workforce will be paid a minimum of 3,000 hours per month. So now with this information, we can prepare the direct labor budget, give it the number of units to produce, multiplied by the amount of time that will be required to produce the unit. The total direct labor hours required in April is 2,600 hours. And then we know that the guarantee hours in the month is 3,000 hours that will be guaranteed in the month. And then the labor hours paid wages is 8 hours. It's $8 an hour. So when we multiply $8, let's say that it's $8. So the wage rate is $8 per hour. That's right. Okay. $8 multiplied by number of hours, and then the total amount incurred in the month of April will be $24,000. Similarly, we look at that in this case as well. So basically, the key focus here is the number of units produced the amount of time required to produce it, and then we apply the guaranteed hours instead of using this hour, and then multiply that by $8. Assuming there was no guaranteed hours, then we'll multiply 26,600 by $8 an hour. Now, overhead budget. The overhead budget would consist of all indirect expenses and production-related costs like plants, insurance, and others. So in this case, we know the indirect labor cost will cost 70,500, indirect materials 7,000, utility 4,200, rent 30,000. 300, insurance cost is 5,800, and maintenance cost is 8,200. And the total budgeted overhead cost in the month of April is 56,000, May 76,000, and so on. Now let's look at the selling and administrative expenses. We have this information here, which is at breakers. The variable selling and administrative expenses is 0.5, which means 50 cents per unit sold. And the fixed selling administrative expenses are $70,000 per month. The $70,000 fixed expenses include $10,000 in depreciation expenses that does not require a cash outflow for the month. So with that information, we can prepare the selling administrative budget for each of the 3 months we're looking in the quarter. So given that $50 per a unit sold, and in the month of April, the budgeted number of units to sell in the month of April, in the example we looked at earlier, was, excuse me, 20,000 units. So if that is the case, it means 20,000 units multiplied by 0.5, that will give you $10,000 as the selling and admin expenses that will be incurred for sales-related costs in the month of April. And now we know that the fixed overhead cost is 70,000 in the month, while the variable overhead cost is $10,000, which is number of units to sell in April multiplied by the rate per unit. And the total overhead forecast or estimated for the month of April is $80,000 minus the non-cash expenses, 10,000. So the cash disbursements required for the selling and admin expenses will be $70,000 in the month of April. The same principle apply for the rest of the months. Now, the cash receipt budget is a little bit what student tends to struggle with when it comes to budget. So it's always good to pay attention to this part and also to look at the materials related to the cash receipt budget. So the key information we'll be using in this example will be the sales that was made in the month, and then any sales that was made in previous month, but the cash will be collected in the current month. So we'll put all that into consideration. Now let's look at how this example works, given that the cash will be 70% of the revenue of the sales in that month will be collected in that month. 25 of the previous month will be collected in the month that follows, and so on. Now, if we look at this cash collection receipt example, at the end of March, the sales that was sold in the end of March, if 25% of that would be collected in the month that follow, it means that if we know that information, what that amount is, then we'll know that we'll take 25% of that. So that gives us $30,000. I don't have that information to share on this slide, but assuming that is the case, we'll have $30,000 carry forward from previous month, which is 25% of March 6 that was collected in April. Now, to calculate the cash that was collected for the sales that was made in April, we know the sales that was made in April was $200,000. We did calculate this earlier in the sales revenue slide. I'll just take you there just to remind you where we got 200,000 from. So right here, sales in April was 200,000, 500,000 in May, and 300,000 in June. So 70% of 200,000 should give you $140,000. Okay, that was the same, which means that the remaining 25%, remaining 25% of the 200,000 will be collected in May, because the information we have here say 25% collected in the month that follows the sales, and 5% is uncollectible. So we have accounted for the total amount of sales. So 5%, in other words, here is bad sales, bad debts, which means unrecoverable debts that cannot be collected. So in this case, when I'll put it this way, the 5% will be considered as bad debt when at the end of the month, the company cannot collect it and it's written off. If it's 5% and you're still chasing the money, it has not been written off, you call it doubtful debt. So this is basically provision for doubtful debt, and it becomes bad debt when you actually write it off. So we see that in the month of May, the 50,000 we have here is 25% of the sales that was made in April, and then the 350,000 we have here is 70% of the sales that was made in May. And then 25% was not collected in May, which is going to be collected in June, and 5% of the 500 sales is doubtful debt. So in the month of June, the total sales, sales that was made in May that was not collected in cash, that was then collected in June, is 125,000, which is 25% of 500,000. And then the sales in June, the sales total 300,000. 70% of that will be collected in June, which is $270,000. 25% will be collected in July, and 5% will be recorded as provision for bad debts. So now the cash disbursement budget is also a way of accounting for cash that will be incurred in each of those months. So breakers pay 0.4. In other words, breakers pay 40 cents per pound for its materials. One half of a month purchase are paid for in the month of purchase. The other half is paid in the following month. No discounts are available, and then the March 31st account payable balance is $12,000. So what we try to calculate with this cash disbursement is what we call the payable budget. So basically, you're making a kind of a budget for the cost, the amount you're going to pay your supplier for each of those 3 months that we looked at. So let's understand this context clearly before we move further. So remember, I said the breakers pay 40 cents per pound of direct material. One half of the month purchase are paid for in the month, which means there'll be cash outflow in the month in which that direct material is purchased. The other half is paid in the month that follows. No discounts are available. If discount was available, we'll consider that in the cash that goes out. The March 31st accounts payable balance is $12,000, which means this has to be paid in the month of April. Now, to do the calculation, we know that it costs 40 cents a pound. And when we go back to the raw materials required, we calculated earlier, which is this one here. This one we have here. No, not this one. Let's get there. So this is the direct raw materials required. So materials to be purchased in the month of April was 140,000 for April, 221,500 in May, and so on. So in the month of April, the cost they would have incurred to buy direct material would be 140,000 multiplied by 40 cents. That will give you 56,000. In the month of May, it's going to be 221,500 multiplied by 40 cents. That will give you 88,600. Now, if we apply that to the case we have in calculating the cash disbursement for purchases or account payable, this is how the result will look like, which is this one we have here. So the amount required to purchase the direct material in April will be $56,000. You remember how I got that, which is 140,000 amount, the quantity of raw material in pounds required, multiplied by the cost per quantity, which is 40 cents. So that will give you $56,000. And 50% of this will be paid in the month of April. So we're going to have 28,000. And this was the one carried forward from the month of March. So the total amount of disbursement related to direct material would be $40,000. And we do the same thing for May and also June. Now, remember there are other expenses that this company may want to incur as well. So the breakers may take a 12% open line of credit for $75,000, maintains a minimum cash balance of $30,000, borrowed and repaid loan on the last day of the month, pays a cash dividend of $25,000 in April, purchases $145,700 of equipment in May, and $48,300 in June paid in cash, and then has an April 1st cash balance of $40,000. So this information will be important in preparing the cash flow statement or the cash balance, the cash budget. Now, with that information, we could start looking at the preparation of cash budget, given all the calculations we've done for the direct material and also the specific purchases that was measured in the last slide. So as I mentioned, it is important to pay attention to this specific aspect because this specific information here are important. However, most of the information we add in the cash budget will come from the previous calculations we did. So the beginning cash balance, 40,000, is given in the information here. So 1st of April cash balance was $40,000. So that becomes the beginning cash balance here. And then the cash collection, which is the cash receipt. So basically we account for all the cash you receive and then minus all the cash you pay out. And then we have the total cash disbursements, the net cash balance in other ways. So in this case, it's 5,000 short of what the company required for the month of April. And how to address that, they could always borrow. But let's talk about these key figures here. So the cash collected in the month of April, we calculated that earlier when we did our cash receipt budget. Let me see if I can take you there quickly. So cash receipt budget, you could say from here there will be cash collection of $170,000 in the month of April, $400,000 in the month of May, and so on. So this is what we are included in the cash collection section of the cash budget. So the other total cash at hand in the month of April will be $210,000. But the cash that is required to be paid out will include the raw materials cash, which is $40,000. We have calculated that earlier in the previous slide for the direct material. Direct labor will be $24,000. Manufacturing overhead will be $56,000. Selling and admin expenses will be $70,000, and equipment and purchase will be $25,000. So if we go back to the raw materials disbursement account we calculated earlier, we could see this information here and this other. So let's have a quick look. So the direct materials, the cash disbursement for direct materials to be purchased, we could see the month of April is $40,000. That is what we have there. And the other cash we included in that disbursement comes from this selling and admin expenses, such as 70,000 cash disbursements in the month of April. And of course, you could also have the other information coming from this section here, other specific expenses that will be incurred in the other months. So we can calculate based on that information, the net cash required available in the company at the end of April to be 5,000, which means the company has net cash balance. So what they will normally do in this case, either they take loan from bank or they issue capital or find other ways to raise this capital to meet their cash needs in the month of April. In the month of May, they will technically have positive net cash flow of 60,500. In the month of June, they'll have positive net cash flow, 86,000. At the end of the second quarter in the year, they'll have positive cash flow, 37,200. So excuse me. So at the end of in April, what they would basically they'll have to borrow some money in order to meet their needs. So if they have negative cash flow of 5,000, I'll give you the information we provided here that the company usually maintain a cash balance of 30,000 at the end of the month. So that means that the amount the company should borrow is the difference between 30,000 and the cash balance at the end, of each month. So if in April the net cash flow is negative 5,000, we'll add that 5,000 to this 30,000. That'll be the cash they would need. So in other words, they will need to borrow $35,000 to meet their cash needs. So that's what you have in this section here: financing, borrowing 35,000, which is technically that 30,000, the 30,000 as minimum balance of cash plus the negative cash flow in the month of April. So total cash required will be $35,000. So the ending cash balance once they borrow this will now be 30,000 because 5,000 out of this covers this cash needs in April. The same principle applies for the rest of the month. Now, let's look at the cost of goods sold. The cost of goods sold could basically come from all of those budgets we looked at earlier. This is a section in the income statement. We could get all of this information from what is the beginning value of the raw material inventory, the raw materials that is added in the current month, and then you have the total cost of raw materials available, and then ending balance of raw materials in terms of the cost of that ending balance of raw materials in the month of April. We look at that in the table earlier, and then the direct materials used. Then we minus, we have the direct materials used plus the direct labor manufacturing overhead, which is the total manufacturing overhead we look at in the previous slide. Then the total manufacturing cost will be 132,000, and then we add the beginning work in process. We add the beginning work in process, and that gives 135,800, and we minus the ending work in process, 60,200. The total cost accounted for the goods manufactured in April will be $190,600. Same principle we apply in the case of May, June, and also we could sum it up to the quarter. The cost of goods sold is basically the number of units that have left the finished goods inventory. And then we could calculate the cost per unit here, given the amount of cost of goods manufactured in the month, okay? Cost of goods manufactured in the month. We divide this amount by the number of units manufactured in the month, in that particular month, and basically multiply by the number of sales that was made to get this amount here as the cost of goods. Okay, so the other way we do that is basically take the cost of goods manufactured, which is the case that was applied in this example here, and then minus the ending finished goods. Those are the goods that have not been sold, are still in the company, and then we get the cost of goods available. We get the cost of goods sold. Okay, so we add this up, cost of goods available for sale, minus the ending value of finished goods to get the cost of goods sold. In other words, we have this amount plus the beginning value of finished goods, total value of cost of goods available for sale, minus the ending inventory finished goods, the cost of goods sold. Same principles for May and June. Now, in terms of the budgeted income statement, That is consistent to what you would have covered in previous topics. So revenue minus cost of goods sold, gross profit, and then you minus the operating expenses. Now, the budgeted statement of cash flow, we do collect this information from all of those cash flow we looked at earlier. If you look at the month of April, this was the net cash in or cash inflow. Just quickly take you there. I try to avoid going back to previous slides, so this video could be may not necessarily be too long. So here's the total. Here was the cash that was collected in the month of April from the cash receipts budget we look at in the other slide, and this will be included in the cash budget as the cash flow for that month of April, as you can see from here. And then we minus all the cash out for the operating expenses. And then the total net cash flow will be minus $20,000. Okay, so now why you say that the negative here, $20,000, is more than the negative we saw in our previous calculation is because we've not taken into account the beginning cash balance that was brought from the month of March. So that will be considered right here in the last part of our cash reconciliation, which is this 40,000 here. Okay, so we didn't consider that in our previous example. We did include that here, which is 40,000 beginning cash balance. So negative cash flow from the operating activities is $20,000, but positive for May and June. And then the next part, we'll look at the cash flow from investing activity. There was no investment activity, but there was investment activity in a cash payment in the month that follows. And that information was given in this part, in this slide right here, that an equipment was purchased. Okay, an equipment was purchased for $143,700, a cash payment of $48,300. So that is considered in preparing the statement of cash flow in terms of cash flow from cash outflow from the operating activity. And the cash flow from financial activity is the money that was borrowed, 35,000, and any other payment of dividends, 25,000. So this is what you have in this section here. And at the end, there was a negative net cash flow if you reconcile the total of all the sessions, the 3 sessions. So where in the month of April, there was really no cash flow for the operating activity, but that cash flow was in May, so we don't consider that. When we add all the total net cash flow from each of the sessions, operating activity, net cash flow 20,000, and then we look at the investing activity, net cash flow from investing activity is 0, and then the net cash flow from the financing activity is 10,000. When we add all of that up, it has a negative balance of all those 3 sessions of 10,000. And then we reconcile that with the beginning cash balance, which is the ending cash balance in March that was brought forward to the month of April. And then we see there's a positive cash flow of $30,000. Why you have this is because the company borrowed $35,000 in April. Now, the balance sheet forecast is, again, taking information from all of the previous calculation we looked at earlier to make up your balance sheet. You know, your balance sheet will typically have 3, basically I'll call it 2 sessions, but in most cases, other people call it 3 sessions. So basically you have the asset section, you have the liability sections, and you have the owner's equity sections. So in this case, we have the current assets here, and then you have the cash flow, $36,000, and then you have account payable, and you have other information here. So you could equally prepare your balance sheet budget for each of the 3 months that are that we look at: April, June, April, May, and June. And then the total liability for this company is $545,000, which is balanced with the total asset, of 545,000. So typically, what this balance sheet looks like, basically look at the total assets, which is the current asset total plus the fixed assets. Okay, the current asset total 155,962 plus the fixed asset total 390,000 to give you 545,962. And then they also sum up the owner's equity 28,400 plus 270,000 plus 300,000 to have 545,960. Now, this budget we look at seems to be fairly relevant to a business that is operating in a single country like the US. But if you start dealing with budgeting for multinational companies, it's much complex. You'll be taking into account the fluctuations in foreign currency exchange rates, the high inflation rates in some countries, and differences in local economic conditions. All of those forecasts will have to be included in the budget. It's more complex. Now, generally, when you prepare budget, there's no single department that prepare all the budget, but the accounting department coordinates the budget. Each department or unit will prepare their own budget, and the accounting department will coordinate that budget, and they put them together as a master budget. That is why when you work today, you could speak to your manager and ask if you could take a look at the budget for your department. And if you are very close to the accounting department, you could ask somebody if you could take a chance to look at the master budget for that year, just to have a clue on how this operates in reality. Now, there's no a silver bullet on how you prepare budget. It will differ from organization to organization. Some of the budget components we cover in these chapters may not be covered in some, may not exist in some organizations. That depends on the organization modality of operation. So if we're looking at multinational company, it's going to be really, really different scenario. Now we talk about budgetary slack. What that means is a situation where there's a kind of behavioral issues or unethical issues. The budgetary slacks occurs when a manager understates its revenues and overstate its costs, so that at the end of the financial year, he will outperform his expectation. And that occurs when managers are compensated with bonus or other type of form of compensation that is tied to performance. So budgetary slack is not encouraged, but there's a way to check whether there's a budget slack even before you get to the end of the financial year. And we could do that by phrasing the budget, looking at what the company actually produced and use that against the standard rates. So I cover that in a different topic, and we'll perhaps cover that later. So I do encourage you to read this section of your textbook, given that your program is MBA course, and you'll be taking a look at budget and see how your department is preparing budget, evaluating managers' budget, and also identify whether there's any what we call lack of goal congruence. So goal congruence is the manager putting the interests of the companies before their own personal interests. And if you have budgetary slack, then that goal congruence is not there. So this is where I will stop on chapter 9. If you do have any questions related to the course materials, you can either send me email or you could meet me during my office hours for more clarifications.